Best Sense Market Summary for the third week of September 2025. And it might be the fifth or sixth week in a row where we've said, well, markets have just gone up by a bit. Well, most markets have. Global small caps outside of the US and emerging markets pretty flat, remarkably unvolatile. The Russell 2000, so US small caps up and down a little bit, up 2% at some point. Of course, gold leading the way again. There seems to be a lot of momentum behind that trade. And Europe up by 2%, Australia down by 1% or so, along with the Nasdaq and US markets last night, when Jerome Powell was basically sounded a little bit hesitant about how much they could reduce interest rates. And then today, again in Australia, we had a sort of similar dynamic whereby slightly higher than expected inflation numbers have certainly put the kibosh on a potential rate cut next week. Well, when we say certainly, there seems to be a very low chance priced into markets, less than 10%. So not so good news for homeowners. And there seems to be a little bit of lingering inflation around the world and in Australia, especially recently. And you can see 10-year bond yields just jumping up slightly by a few basis points. The other notable market moves was in Japan, where earlier in the week or the end of last week, they announced that they were going to start selling some of the ETFs that they bought to sort of basically prop up the market over there. And then shortly afterwards, they said, well, they'd maybe take 100 years doing it and markets are sort of back where they started. But a little bit of volatility there. But overall, markets mostly up and, pretty quiet, really, and eerily quiet in a way. When you look at performance of markets year to date, you can see that global small caps, emerging markets up by some 30%. Of course, gold up by more than 40%. And even the Nasdaq, having been down 20% at some point just around Liberation Day, is now almost up 20% for the year, having made back those gains and more. And Japan has been following suit and up by almost 20%. Australia up by 10%, which, 3/4 of the year through, not too shoddy either. But the really striking thing about the last few weeks, as I mentioned, is the lack of volatility. It's been this endless sort of march upwards. Now, that could be, if we look at the bottom panel, that could be the effect of interest rates, but that also implies that growth's slowing, and we have seen signs of that as well. So you might think that those two things sort of offset each other to some extent. One of the things that we've been digesting this week is Andrew Hunt of Hunt Economics' latest US money report, and there he tracks the flows around the world, but certainly in particular coming in and out of the US. And this is the chart that stood out. We've talked about this before, and he's talked to us about it. And if you zoom in on the very right hand side of this, you can see that the surprising thing about this year and throughout the Liberation Day and tariff negotiations that have happened since is that money has flowed into the US. People have front-ended these tariffs. There's been inventory building in the US, and basically the end result has been capital inflows and a widening of the US current account deficit. Now, you might expect that to reverse, like that's actually the whole point of the tariffs. But for the moment, you can see the last few weeks at the very right-hand side of that graph, that's been ramping up even more. And the way Andrew puts it is that basically investors, especially external investors, have not only been pushing money into the US to build inventories, etc., but also latterly they've effectively bought the rate cut. And what that means is basically they're betting on the fact that the economy is not that bad, we're not going to see a recession, so actually net things are getting easier from a monetary point of view, and it's probably going to be supportive of growth. So markets are maybe betting that the Fed is being pushed into being a little bit too easy. That's again something that could lead to inflation, but bond markets aren't reflecting that. So overall, a pretty confusing picture. But one of the other things that Andrew mentions in his US money supply report this week is that underneath the surface, there's actually been an implicit tightening as well in the real economy. And that's basically because building up the Treasury General Account, which had been depleted, involves effectively crowding out credit supply. And so with less credit going out into the real economy, it might be expected to see tighter conditions. But that seems to have been offset by this huge wall of money of external capital. So maybe masking something that's going on in the US economy. Now, that's something that we also talk about, or something similar, with Greg Dean of Langdon Equity Partners, where he talks about this growing disconnect between what's happening on Main Street, which is the real economy, and what's happening in markets. Now, interestingly, Greg's portfolio actually sailed through Liberation Day because those particular sort of set of companies seem to be quite idiosyncratic and not really affected by liquidity. So it's another sort of data point which suggests that maybe liquidity is driving markets, and something that he's been scratching his head over is actually the last 6 weeks, for no apparent reason, his portfolio of companies have been a little bit on the back foot. Year to date, it's still okay, in line with the market with less volatility. But maybe it's the other side of the coin of what we saw in Liberation Day, and just another data point that suggests that liquidity is a dominant force and there is this tide lifting all boats. The question is, what happens if the tide withdraws? And you'd think that the overall aim of the tariffs is to reduce the current account deficit, that maybe we're going to see the other side of that coin in the next few months. Now, the other thing that Greg talks about is the lack of transparency in company earnings, because basically what we're reporting on is all this front-ending period. But the outlook, as we've heard from some of the largest companies, has been a little bit more mixed. Greg's actually of the opinion, he has quite close relationships with a lot of these companies, that actually we're not going to see for the next quarter or even maybe the next 2 quarters, we're not actually going to see the real impacts. And when he talks to these companies, they say we simply don't know. So there is a little bit the fog of war at the moment, and we think it's going to be an interesting few months to see how this unfolds. But for the moment, our takeaway is that things are eerily quiet and maybe best to be on your toes a little bit. Anyway, lots to talk about next week. Look forward to that.